What are the different types of life insurance? Life insurance is a type of policy which pays out lump sum amount to your loved ones if you die. Which covers the policy. And this policy is to provide a financial security and safeguard your family future, and is probably one of the best gift one can ever gift to their loved ones. In this there are different types of policies available. 1. Family life insurance is an insurance policy you can take out to help make sure your family would receive financial support if you passed away during the time of policy. 2. Whole of life insurance is a type of policy that are mostly like an investment. In these you will have to pay the premiums as long as you last, and this policy pays out lump sum amount to you dependents upon a successful claim after your death. 3. Over 50s life insurance is a type of insurance policy. It is specially designed for policy seekers who are above the age of 50. In this there will be fixed monthly premiums that suits your budget on your fiscal situation. 4. Critical illness life insurance is a type of insurance policy that offers a protection in the event of a serious illness or injury. If policyholders suffers a illness or a injury like cancers, heart attacks, serious illness, organ transplants, etc. 5. Income protection insurance is a type of insurance to give you some cover if you cannot earn an income for some of the reasons illness or injured. 1. Term plan. Term protection is as of now a general and basic sort of life coverage accessible in the market. An individual enters the term of protection and pays the premium in a specific period. In the event that life has been guaranteed, during the strategy time frame, the total protected will be conveyed to his family. 2. ULIP. Under this approach, the protected is obligated for acquiring life coverage and furthermore to assist shared speculation. A segment of the cash is utilized to put resources into the stock, security and obligation reserve picked by the policyholder. 3. Gift plan. The gift plan is another kind of life coverage plan, which is a blend of protection and reserve funds. A fixed sum kept for extra security, protection, while the rest contributed by the disaster protection organization. In the gift plan, if a disaster protection arrangement presents. 4. Entire life approach. This sort of strategy gives perpetual disaster protection. For whatever length of time that the safeguarded does not pay the premium, the entire life arrangement gives an investment funds part and lifetime security spread. Under this arrangement, recipients get a passing advantage after the demise of the existence guaranteed. 5. Cashback disaster protection. This arrangement is an interesting sort of disaster protection strategy, in which some level of the whole safeguarded paid back to the guaranteed as survival profit by time to time. Cashback plans are likewise qualified to get the rewards proclaimed by the organization occasionally. A very basic understanding of life insurance indicates it is basically an agreement between an insurance company and a policyholder, where the company agrees to pay a designated sum of money in exchange for an established premium sum of money from the policyholder. There are 6 different types of life insurance. 1. Term insurance. A term insurance policy provides for the immediate needs of the nominees in the policy in cases pertaining to the sudden death of the policyholder. 2. Money-back policy. In this policy the insured individual receives a fixed amount of money at specified intervals through the duration of the policy. 3. Endowment policy. An endowment policy is a policy where the policyholder is paid a lump sum amount on maturity of the policy or upon death. 4. Unit-linked investment policies. ULIPs allow the policyholder to enjoy the benefits of an insurance as well as an investment. 5. Whole life policy. A whole life policy covers the policyholder throughout his lifetime. 6. Pension policies. A pension policy lets an individual decide on a fixed amount of income after retirement. There is only one type life insurance plan that can actually be called a life insurance plan. It is called term plan. Term plan is insurance cover provided for a term period for a fixed sum assured. In simpler term, one pays a premium, fees, for a fixed sum assured to be paid to the nominee for which this life insurance is purchased. For illustration, one can buy a term plan of 1 crore for a premium of 8K to 12K for a term of 15 years, 30 years, 45 years. You will have to pay this amount for a term chosen by you. The sum assured of 1 crore will be provided to the nominee upon the death of person insured within the period of the term. The premium is decided on the basis of age at which you are starting the insurance policy and health of the person. The purpose of life insurance is to provide the cover to your dependents to continue the lifestyle that you could have provided and take care of the financial needs. Basically, the term plan protects your income that you would have earned for your family and dependents that you would have earned in your lifetime. Therefore, your income is an important factor while buying life insurance. There are other types of insurance available such as endowment plans and ULIPs, but in my personal opinion their purpose is compromised as the sum assured is not calculated to protect your income and risk associated is not aligned with the purpose of life insurance. Endowment gives money back at a minimal interest rate and sum assured is very small compared to term plan, and unit-linked plan gives returns linked to underlying assets. If primary objective of life insurance is to protect your income that you would have earned in your lifetime, neither market-linked risk is justified and nor a small sum assured is correct. If earning returns on investments is the objective, one should invest in equity or mutual fund or real estate. And sum assured should be high enough to take care the needs of your dependent.